Salesforce lost $50 billion in market cap. The issue is that Salesforce said we have fallen to single-digit growth, and we're not coming back. Ready to go?
Jason, I am so excited for this, dude. First, this is the first one we've ever done in person.
I am so excited. It is great. The studio's great. This is better. I'm just so proud of the team, everything at 20VC. It's great. So it's great to be here.
Dude, it is so lovely to make it happen in person.
Yes.
Now, this is like a new show in the way that we're calling it This Week in SaaS.
You're going to do it 52 weeks of this?
We're going to do 52 weeks, and you are too.
Okay, very good.
No, you didn't get them.
I did not. I got the Google Doc share did not work properly.
Okay, well, so basically, it's like This Week in SaaS. So we
Yeah.
go through the biggest stories from the prior week in SaaS and unpack them. Okay.
All right. You picked a heck of a week.
I picked one hell of a week, and so we're going to start like all positivity in mind. PluralSight, right?
PluralSight.
Yeah.
Okay.
So the PluralSight news was that Vista wrote down their $3.5 billion buyout of PluralSight last week to zero. Crazy.
Yeah.
Can you unpack just what actually happened for those that didn't hear about it?
I mean, they bought PluralSight for $3.5 billion, and they couldn't service the debt. They used $1.5 billion of debt, which is the PE playbook, right? And I assume they had to refinance it, right? So the press said that PluralSight had about almost 30% operating margins now. So let's say they're doing $300 million in ARR.
Yeah.
So they're generating $100 million of free cash. Maybe let's handicap it to 80, but the debt service on $1.5 billion was too much, right? The debt service. So they walked away. The story seems odd, and I also read that they put some of their IP in another second company, so there may be some other odd things going, but literally to mark down $3.5 billion out of what, a $20 billion fund probably, something like that, right? That's devastating. More worrisome is you had Mark Sister on the show recently, right? And he was talking about how PE is going to be the big savior because they're going to come in, and this is what we've seen in SaaS and cloud the last couple of years. PE bought a lot of things that couldn't quite IPO. Right, that couldn't quite get there. You and I talked about some exits I had. I had a bunch of exits to Vista and others, and this is
your two biggest. Actually.
Yeah, and for founders and investors, this reduced a lot of stress. It's just been a relief. But if this is falling apart, it's tough. It's harder for founders. If you want to talk about my theme for This Week in SaaS, there actually parts of SaaS are really good. What I call B2B to C is good. B2B to B is bad, but it's harder for founders.
Okay, so B2B to C is good. What is that? Just so we have an example.
Canva.
Okay.
Or broadly, B2B to B is selling B2B software to tech. That got cratered. That's Salesforce. That's Mongo. That's that's UiPath. That was the hottest thing in 2021. That's how we all had these big funds and exit. And I think it's an overreaction, but everyone in tech is still cutting. It's 2024, they're still cutting. Benioff was on his earnings call the other day saying they're still cutting. People are still cutting back their tech spend in tech.
Is this not just like a reflection of where we are in the adoption curve of newer PLG models? So when you look at like Canva, which is like absolutely rocketing in the consumer subscription space with their thesis that will then lead to people bringing it into the enterprises they work in, and then they adopt from the enterprise as well. Are we not just early on that adoption cycle for Canva for some of these players? And I
don't think it's PLG. I think, you had Aaron Levy here the other day too, right, from Box. That, he said something a couple of years ago. He's like, PLG is just what like we used to do, just with a new label. PLG is just freemium with better analytics. We've been doing freemium since the early days of the internet, right? A lot of us I started freemium, Box started freemium, a lot of the OG folks started freemium, right? Even Salesforce started very SMB, almost freemium at the edge. So I don't think that's new. PLG is just a new way to describe more sophisticated motions, but this is not new in software. We have been trying software on the internet since WebEx, since the early days. So I think Canva more is a reflection of two things. One, the U.S. economy and most of the global economy remains strong. Unemployment's almost nothing, right? And so Canva is selling to normal consumers and small businesses, and they're growing 40% at $2.3 billion in revenue. $2.3 billion in revenue. It's essentially accelerating. That hasn't changed, but tech companies are just continuing app layoffs. We thought it would be over. They're still cutting to the bone, right? We see it at ZoomInfo, we see it at Zoom, we see it at so many others. They're still cutting, and it's brutal.
I do just want to go back to the PluralSight story because I
Yes.
just want to understand, Mark Suster said about our show, he said that actually P would be the primary buyers
Yes.
for the next generation of software companies. With news like this, does that make it more difficult? Will we see less? Do you think he is wrong with news like this coming out?
I hope he's right. I thought he was right. I am, listen, losing $3.5 billion, you can only do one of those every 4 or 5 years, right? Listen, you've had PE guests. You can do more of them. It's interesting. I think it's very interesting for SaaS, but the loss ratio can't be very high, right? You can maybe some of these deals
It can't be high at all. I interviewed them. They say, barely ever.
Yeah, and the real goal of PE is if you use debt correctly, even when you lose, you win. Because you've taken so much out, right? Or you've put so little equity. And if you can put in 10, 20% equity and leverage it up, like you win, even if you lose, you win. As long as you have an exit, you win, right? If folks are going to be writing off billions, because there's so many of these, there's Avalaras, there's PluralSights, there's infinite number.
We mentioned Zendesk, we mentioned
Zendesk for $10 billion. What if Zendesk was $10 billion, Anaplan was close to $10 billion, right? What if that debt can't be serviced? Then we're writing off $20 billion. Like, this is not $1 trillion industry, right? I don't know the average size of you had the founder of Thoma Bravo was great. That was a good one, right? Yeah. But even that's like a $20 billion fund, isn't it? The last Vista one was $20 billion.
I think theirs was a $30 billion.
$30 billion.
That's a lot of the fund.
Yeah, so it's just maybe you do one of these on a blue moon, but if a lot of these big deals, which seemed like you couldn't lose, right? You buy Zendesk for $10 billion, you invest a little, you take some pressure off, and then you take it public 4 years later. That was gold. That was gold.
Okay, so we have this kind of litany of companies that's to come in this field potentially. Yeah. Will we see LPs shifting allocations away from PE towards publics and more liquid assets, towards venture? Will they continue the same and just say, it's fine, you can have your shitty funds, it was a tough vintage?
You would know better than me, but the recent conversations I've had with my LPs is I do think there remains, if you're still investing, if you're still committing capital to managers, there's still optimism. There still is optimism in these asset classes, and there is tolerance of a bad fund or two, whether there should be or shouldn't. I'd be curious what you have to say, but I did about 3 LP calls, and again, my universe is small. I didn't hear, the only fear I heard was crazy AI deals. I didn't hear any other fear, right? The best folks have made 20% IRRs from these alternative asset classes, and that's the goal. How else are you going to make it? How else are you going to make it?
Just on that, I know it's a tough one, but what is a crazy AI deal versus a not crazy AI deal? Because I see some of them too, and I go, God. But then I look at the people involved, and I look at the quality of those investors, and I'm like, maybe I'm wrong. I look at Thrives and Sequoias and DSTs.
Or conservative folks like Bessemer, right?
Conservative folks like Bessemer potentially doing Perplexity
at $3 billion,
yeah.
right?
Bessemer are good,
but conservative.
Yeah,
in a good way, but conservative, right? So they've got to believe. They've got to have high confidence they can do to 3 to 5x in that, including dilution, and a genuine belief of 10x. Right, so you've got to believe that Perplexity is going to be a $100 billion company. You've got to believe that there is room for $100 billion companies coming out of this. Yeah. I guess. Listen, we're all learning, right? If OpenAI literally, essentially in 3 years went to over $2 billion in ARR, and you have the bull case and you keep tracing that out. Maybe there is room for $100 billion outcomes, right? It's crazy, but AI is, the amount of spend is huge. If we maintain this spend, just look at NVIDIA, right? Just look at, and so if we maintain the spend.
We say the spend is huge and it's getting bigger and bigger. Is the spend being created net new, or is it being taken from elsewhere?
It is all being taken. There is no net new. Gartner just did a report the other day, and they slightly upgraded actually the amount of spend in SaaS this year to 20% growth this year. 20% growth. Pretty big, right? And they said Gen AI is fueling it, but it's substitution. I literally was listening to a gong call the other day from a portfolio company, from a large public company, but that's struggling a little bit. In their category, they were going to churn 12 apps this year and buy 1 AI app with some of the budget. Kill 12, buy 1. That's a substitution budget, right? And so I think it is confusing. It's confusing, right? And I think for classic B2B SaaS, it's stressful. Like we for the last, I would say until 18 months ago, we never fully had to figure out where this budget was coming from because SaaS kept growing 20% a year like clockwork, and it went into the same stuff. It went into ERP and CRM and the same tools, and we kept buying more and more, and our stacks got bigger and bigger and arguably bloated and bloated. Now every founder needs to actually, for real, know where budget's coming from. You've got to know, right? And it's sad when I talk to some founders or even listen to some portfolio companies where very happy customers are churning to create AI budget, to free up AI budget.
If you actually
happy customers.
If you advise me as a founder that I'm in your portfolio,
yeah.
Okay, I have to know where budget's coming from. Do I say to my champion, Jason, just out of interest, where am I coming from in your budget line?
All the best salespeople ask that question. On a first discovery call, Harry, when I'm meeting an enterprise customer, so tell me, is this purchase budgeted for this year? Is it budgeted? First time I heard this from a sales rep, I kind of squirmed. I'm like, that's a little salesy, isn't it?
It's like asking,
But an enterprise buyer doesn't mind that's been buying apps for a decade because they just want to frame the conversation. No, Harry, it's not budgeted. I'm hoping to get a little extra budget or some discretionary, but it's not budgeted. Or yes, Harry, this is a multi-year project we're doing. It is budgeted. I'm not going to tell you how much, but it is budgeted. It's a fair game question.
Do you worry about not playing the game on the field? And do you think it's important to play the game on the field? Bill Gurley said, when it was kind of crazy 21 times, you got to play the game on the field. You got to play the game on the field.
Yes.
You are not really investing heavily in AI like every other fund or the majority of other funds.
Yes.
And you invest slowly. Do you worry about not playing the game on the field?
Yeah, I think my strategy is wrong. So I've never lost money ever, anything ever. I've always, every fund, every startup, everything, always made money, always made pretty decent returns, right? And so there is some conservatism in that. And when I started in venture, I think it served well.
Do you think that was good for you?
What's that?
Do you think that was good for you? And I don't mean that badly, but I've lost money. I have actually lost money, ridden off, and actually it was the time of deepest self-reflection
yes.
and learning.
Do I think? Well, listen, I've had. This will be the first year I've ever had any investments that I had to write off was this year, but the funds will still do fine, right? They'll still do fine. I do think it's bad. I think that I took LP's money too seriously. I certainly took it way too seriously when I started investing, when I worked at someone else's fund. I shouldn't have given a rat's ass about whether I lost money or made money. And I think I've cared too much.
Why? Because the only thing that matters then is you're building your track for something else.
Whatever, yeah. Just roll the dice. If I win, I win. If I lose, I don't tell anybody about it. If it's not your own fund, you can only win if it's not your own fund. You can only win. I took every deal. My first deal was $800K, my first check. I sweated bullets. I did 10,000 reference calls. I did everything. It took weeks to do all the diligence, and there was no need to do that. It wasn't my money, and that was Pipedrive. It did well. It sold for $1.5 billion, but the first check was tiny. It was $800K. There are advantages to doing that, right? And the biggest advantage is you don't have a lot of stress. Right, you don't have a lot of stress. You don't have you're going to lose your shirt kind of stress. But no, I do think you should take your LP's money less seriously than I do. I genuinely think it's a bad thing. Just like when you raise money from VCs, the more you raise, the more serious you should take the capital. But I worried too much as a founder. I remember about losing single-digit millions for my VCs. I shouldn't have worried about it. It was bad for them, and it was bad for me. I stressed it too much. They can survive. A $400 million fund can survive emergence, whatever, too, which is like a 10x fund, could survive losing $3 million on my investment, right?
You always talk about being the asterisk in their returns.
Yeah, I shouldn't have worried about it. I shouldn't have worried about it, and I would have made different decisions. I think it's bad what I see with so many managers, especially with SPVs and opportunity funds, they literally don't care if the SPV goes to zero. They don't care at all. They don't give a rat's ass. I've never done that. I have 2 opportunity funds, but I've never done an SPV where I didn't give a rat's ass. But I would have invested 2 to 3 times more if I had. Just spool those SPVs up. If they don't make it or the valuation is so high, just hide it. Just ignore it. I genuinely think that's probably the way you should play venture. And but it's not my DNA. It's not worth it.
I do want to discuss Salesforce. You mentioned that
yes.
kind of B2B2B and the challenge of spend being so hit, but actually
yes.
also Gartner saying up 20%. The news from Salesforce this week was shares tumbled 20%, the worst since 2004, with the news of weaker than expected results for Q1.
Salesforce lost $50 billion in market cap. Yeah, brutal.
On a miss, though, of 1.4?
That's not the issue. The issue is that Salesforce said we have fallen to single-digit growth, and we're not coming back as far as we know. I think next quarter they're predicting like 4 or 5% growth, and for the full year, single-digit growth. People misunderstood it. It was not the miss. No one really. I mean, missing this quarter is minor. These devastating falls from Salesforce and Mongo and Workday and others are about that they're all ratcheting down where they think things are going the next year. That's kind of the discouraging thing, that we haven't come out of it. We haven't come out of it. Salesforce is saying it is not getting any better, and because of that, we are falling to single-digit growth. And why does that matter? First of all, it's not a growth stock with single digits, right? Yes, they're at 30-something% margin. That's why the market crashed and created this whole cascading effect. Mongo said growth is going to be in the teens from like 40% 18 months ago, right? Huge change trying to get tech companies, their tech customers. But the troubling thing, Harry, is that in B2B and SaaS, for more enterprise stuff, we kind of rely on this 115, 120% NRR to carry us.
Yeah.
Like Fastly last year grew 15% with zero new customers. They didn't close a single net new customer. Now, how did they do that? 115% NRR.
They didn't close a single new customer.
Not net. I mean, it's not one of the top performing ones, but it's
not one of the top. I hold it, and it was shit.
It's on the one hand, it shows that the market is passing them by. On the other hand, it shows the power of what you're supposed to do with mid-market enterprise deals, which is have the triple-digit NRR. Salesforce is the most enterprise there is, right? That and ServiceNow is more enterprise, but why isn't the 115% NRR playbook working for them? Right? That's the troubling thing to unpack.
Why
right?
isn't it?
Well, the short-term reason is everyone is cutting seats. Everyone is cutting seats, right? And what Mark said on the earnings call, what the team said is, and also because of that, so many deals that have closed are a fraction of the size that they were projecting. Much smaller deals. And so they say that it's layoffs and stuff, but it's not really layoffs. Again, the unemployment's pretty low, but tech is very specific. Layoffs have been tougher in tech, but now people are like, maybe we can get by with 100 seats, maybe 200 seats. Maybe we don't need as much Slack or as much MuleSoft or other pieces. And they're just rationalizing. And I don't know what the effective NRR is for Salesforce, but it's crummy. People kind of fake NRR, net revenue retention, like how much recurs, and people like they'll cut out their smallest customers, they'll cut out segments. But how could the enterprise leader grow 7%? It shouldn't be possible. It could happen with an SMB one that stumbles. It could happen, but this wasn't supposed to be possible with enterprise SaaS, just because NRR should last forever. So that is troubling. And again, that's also kind of the engine behind PE and everything, is that traditionally a lot of these PE firms have not done SMB stuff, right? When Vista bought Pipedrive, I wasn't there, but a lot of discussion was how unusual it was because it was a high churn, very small business. They're like, that's not the playbook. The playbook is, look, we're going to go in and buy Marketo, which was Vista's first big deal, peer of mine. And we won't add a feature for 4 years, but it won't matter because of 120% RR, right? We'll go in, we'll buy it at 200 million, then it'll be 240, and then it'll be 300, and maybe in 10 years it'll fall apart. But why isn't that not working at Salesforce? It should worry all of us, right? It should worry all of us.
Is there not a direct correlation though between that and HubSpot's growth? Like when you look at actually HubSpot's growth of CRM,
yes,
and compare that to Salesforce's deteriorating NRR, is that not combined?
For sure, and HubSpot is still growing almost 30%, right, at $2.5 billion. But HubSpot's NRR is down too. It's down from 110 to 100. So they're seeing pressures too. It's not any easier then. For sure, the fact that HubSpot is coming up, I think, on $700 million in revenue from CRM is a dent for Salesforce. But there's always competition, right? And Salesforce has 5 clouds, and sales is not is I think their third biggest cloud. It's not even their top product.
What happens if these companies are no longer growth stocks? What happens if we just accept the new norm that they are growing at 5 to 7%?
It feels like Dropbox has settled into that.
Yeah.
It feels like maybe even as much as I love him, maybe even Aaron Levy settled into that too, right? I love Aaron's very aggressive and builder, but I think they have such high saturation of the market. I think we are seeing some great companies like Dropbox and Box settle into that and just feel that unless they have a huge market cap and they can go buy something, that it is the world, right? It is the world.
Yeah. I had Aaron Levy on the show, and he was like, we're going to go from 1 billion ARR to 2 billion ARR.
He will.
In as fast as possible. That is my goal.
Yeah, but at 6% growth, it's still going to take him how long? 10 years? Or I'm doing my compounding wrong. 8 to 10 years, right? And he'll get there. He'll get there, right? And I don't think Aaron settles for anything. I think he's one of the best founders that I know. But he's not saying we're going to get back to 30% growth.
Just help me understand why we have seen the tapering of growth though. Is it like just incredible saturation of market? Is it lack of growth in market? Like why is this?
Everyone on Twitter thinks there's one root cause. Again, if Canva's at 2.4 billion growing 40%, if Samsara is growing over 40% at 1.3 billion in revenue, okay? If Zscaler, I think, is growing 40% at 2 billion in revenue on the security side, it's not like we're in a downturn, Harry.
No.
Now segments are in a downturn, but you can't say all is bad. It's not all bad. Toast is growing 30-something% at 1.3 billion in revenue. Okay, like there are portions. Vertical SaaS is strong. SaaS to consumer is strong. Security is strong. Just this thing to tech is bad.
You look at your Klaviyo, you look at your Gorgeous.
Klaviyo is, look at Klaviyo for a minute. They're growing, I mean, the growth's come down a little bit, but they're growing, I think, 50% at 750 million in ARR, right? So all these woe with me people are like, this Klaviyo sells to real merchants, to real, they're going more enterprise, but it's really a 5K product. It's SMB, right? And they are growing at epic rates. So it's not a downturn everywhere, but it is. But the tech one, it's brutal. It's brutal, and it's across the board in tech. Yeah. But I think to answer your question, so. First of all, let's make sure that consumer SaaS, vertical SaaS, and security are all excluded because they're doing pretty well. And then let's realize because everyone's so brilliant on social media, let's realize there's a couple different root causes. Okay, and this is just my learnings. I'm not sure I'm right. I would argue Salesforce is massive cuts, budget cuts. It's brutal. It's brutal out there. Everything's harder. Salesforce also just said that now they need 3x pipeline coverage versus 2x historically. So in other words, if they want to close $1 billion, they used to need $2 billion of deal in flight. Now they need 3 because it's just 50% harder to close. So that's one set of issues. What Salesforce got right was they have a lot of clouds. HubSpot also got this right. HubSpot, if it didn't have 5 core products, it would be slowing. When we look at the boxes and the drop boxes, and I think both Aaron and Drew are honest here, they were very late to go multi-product, and arguably Dropbox isn't multi-product at all. Arguably it's one product. Box is kind of getting there, but I would say it's like multiple facets of the same product. So that's a different existential issue that founders need to be laser focused on after a certain amount of customers, just to not exhaust the one product world. We're getting better at it, but I think getting caught as a one product company is very different than Salesforce getting that right, but seeing saturation in multiple products.
A final one on this. Does AI not allow them to have so much more juice in their customer base? And what I mean by that is like Salesforce have the distribution, Box have the we've mentioned that incredibly high saturation. They can integrate generative AI,
yes,
or you name it. Like Aaron on the show talked about integrating AI into their storage solution so you could extract knowledge way more efficiently from the docs you have. Does that not allow for a much more increased ability to price far higher, and actually they will be able to leverage AI to get a lot more money out of their existing customers?
We'll see. Dell also had a miss. It wasn't as big a deal as Salesforce and Mongo and DB. And what Dell said is, look, there are a little bit of benefits from AI and that we're shipping more servers, but our margins are down, and net, we're not doing any better. It's not helping us net. Salesforce, Mark Benioff on the earnings call talked about how amazing their AI products are. Amazing. Like they couldn't even, the analysts kept asking him to talk about other things. He went on and on for half an hour, but is it increasing this revenue? Right? Even ServiceNow, like it seems like it's doing well, but the average ServiceNow customer signs over a 3-year contract with 99% retention. How can we even tell? Like, he's a great CEO, but like we don't know if it's really making any difference in terms of the top or bottom line. I'm not saying I think all the products are going to get better. I bet Box in a year will be a much better product than it ever has been. Much better. And Aaron's right. The problem with all these products, and I've built one, is it's very hard to deal with this unstructured data. It's very hard how do you communicate with a document? It's very difficult, right? So if AI allows me to finally communicate with my 10 million documents in Box, I think Box could be a 10 times better product in a year. But will that lead to any revenue growth for Box versus OpenAI or Google Cloud? So far, the evidence is no. So far, it says the incumbents they're gonna do great things with AI, great things. The product's gonna be much better, but it's not clear they're going to get any revenue boost from it. No one's saying that. None of these leaders have saying they've gotten any revenue boost. They keep talk, right? Even the great ones like Aaron talk for an hour, but right now we're not seeing a boost. So it is worrisome, and there is an experiment budget, and it is a substitution budget, and I think it's going to take us another 24 to 36 months to figure it out. But the only one thing I will say, you got to do it. You got to do it. If you're competing with Box, you got to at least have as good AI as Box. If you're competing, it is table stakes now. So even if, as frustrating it is that your engineers have to drop everything and build these cool products and deal with hallucinations and deal with the cogs and all the issues and all the integration, if you resist this, you are going to get steamrolled because the customers expect it. They're looking for it. How they pay for it is a different question. But I see too many founders still hiding or running from AI or mocking it or making fun of it, and I think it's a path to destruction.
Do you not think we will have an AI budget line item created for all CFOs? Because right now we don't actually have
No.
that, I think. You don't think we will have that?
Do you know any CFOs that are creating an AI budget? And where did they get the money? Where did dad or mom give them the money?
I don't know any that have it.
No, they're substituting. They're substituting.
We mentioned Box. When I had Aaron on the show, and live in the show, I was like checking his market cap.
Yeah.
And he's like, billion ARR, and it was a 3.9 billion market cap. I said, dude, this is so depressing. I was brought up on like the 6 to 8x at least. And you're like 3.9x.
Yeah.
And my next stop was UiPath,
right,
which, you know, is $6.9 billion market cap, which is 4.2x revenue, basically. My question to you is like, are you as concerned as I am by the compression that we're seeing in market caps to revenues?
I'm concerned.
Yeah.
I'm not concerned about the boxes and the UiPath. I'm concerned that we've only had 2 SaaS-ish IPOs since 2021. We've only had 2 since HashiCorp was the last one of the bubble of December 2021, right? Just got bought for IBM. We've only had 2. We've only had Klaviyo and Rubrik. Both essentially were at 500 million, growing much more, going 50% for Rubrik and 70% for Klaviyo. They're both trading at like 6x. I don't mind if, listen, I love Aaron, I love Box. I don't mind if Box and Dropbox and a few others trade at modest multiples because the growth isn't there. The fact that a Klaviyo or Rubrik isn't trading at 20x, 15x to 20x, I don't mean to be a Debbie Downer, but it is where we need for the math to pencil out. This is the truth in venture, and founders should understand this at some level. I think for the math to pencil out in venture, we do need a rebound. The math, and this is, forget about the unicorn rounds and the crazy. We do need a 30 to 40% multiple reflation, or we just can't make any money on any round north of 100 million valuation. Can't make any money.
Listen, I agree, but you said you're not concerned by UiPath. UiPath are growing 31% last quarter.
Yes.
22%, I think, year on year. It's pretty good.
Yeah. I just meant the drama with Daniel coming back and the market hit. I think that'll pass, right? The market had a little panic when we had a CEO turnover and change.
How did you read that? Because for me, I was like, actually, you know, great companies are most often run by the founders themselves. That should have been a confidence surge in some respects.
That he came back?
Yeah.
But it was in like 7 months.
It was short.
It was short, right? Listen, I think that the Salesforce crash was merited based on the projections, not on the miss, based on the projections. I think the Mongo crash was merited based on them saying, hey, we're only going to grow in the teens. Like Mongo was always supposed to be a high flyer. But there is some overreaction here, right? There is some overreaction. But listen, I don't know about UiPath. I think it's definitely positive. I think, you know, the vast majority of SaaS companies that are public are still run by their founders. Eventually people get tired, right? People, they can't do it. I mean, you can't do it for 100 years. This is kind of hard. But yeah, it should be positive. But I think it will be positive maybe in a quarter, right?
Okay, super hard. When you mentioned founders get tired, things change. HubSpot's founders are less involved now. Obviously, they've got Yamini as CEO, and then there's the rumored $33 billion Google acquisition.
Yes.
Do you think that goes through?
Initially, I thought this was a creation of social media. When I read the first article about it, which was like self-referential, it didn't even attribute it to anybody. It said, because listen, I was briefly a VP at Adobe, and I saw how M&A worked, and there's targets. Okay.
I would love to see you with like a swipe card going into Adobe.
Well, my ideas were pretty different for the targets. We can talk about that. But, you know, a couple of years ago, Business Insider published a leak from Salesforce where they had all their M&A targets. And it was very interesting. And at the bottom, they had receptivity. I remember Box, it was not uninterested in selling. So they had all the potential, like the top 20 targets. It was one of the, I mean, Business Insider is up and down, but this was one of the good ones where they leaked it and talked through it. So the fact that Google Cloud would be looking at HubSpot is meaningless to me. Of course they should, right? Of course they should be looking at every leader and saying, okay, listen, who's a good, like in some ways UiPath is a good match for like the enterprise push of Google Cloud, but maybe that type of automation is not where they really want to be. If they want to go SMB, if they want to combine with G Suite, then it's a good fit, right? Because they have a great footprint. So when I first saw it, I thought this was stupid. It was like, yeah, it's on someone's slide, and so are 40 other companies. But maybe it's possible. The only reason I say this, and listen, if I knew anything, of course I would not say anything. It feels like people are a little quiet at HubSpot. When you see the executives go a little quiet, yeah, that's my tell, right? Not like, just like, so, you know, that's the only reason why.
But there's a genuine question of like, from a regulatory standpoint,
yeah,
could it go through? At 33 billion, that passes the bar of meaningful to regulators. You know, I was going to ask you about Clearbit, which was acquired for 150, and just what you thought about that. Respectfully, it's too small for regulators to give a shit, really, I think, bluntly. But 33 billion, oh, they care.
I don't think Figma deserved the antitrust ding that it got. I think if Adobe bought Canva, that'd be a much bigger issue. I think Canva is an existential threat to the whole Creative Cloud. Figma is adjacent. If antitrust looks at Google and says, hey, Google is arguably the #1 marketing platform on planet Earth, and HubSpot is a marketing company, I'd block it. If you slowed it down and said, listen, this is a CRM with support, with all these other pieces, and it does some email automation, you're like, this is fine. This is what this should be. So I do think it's risky, because a lot of folks do think that HubSpot is primarily a marketing company, which is no longer really the majority of the revenue. So I think it is a crapshoot. So I don't know. I don't know that they would agree to it. It'll be interesting to see. Antitrust is a bummer too. It's like PE. Like it's a bummer for SaaS that it's hard to get acquired, because it just creates a cloud across M&A, and the PE stuff's a cloud. These are like double clouds.
They are double clouds. You said to me before about kind of Figma and Adobe being seen as competitive.
Yes.
And you said, actually Canva is more competitive in that respect. And you said it's a threat to the whole Creative Cloud. Why do you think that is?
Well, I mean, Adobe, the majority of Adobe's revenue is still from designers designing assets in Creative Cloud, and that is exactly what Canva does. It's not prototyping products, which is what Figma is great at. Adobe had, I forget what it's called, is it XD or something? Adobe had a trivial product doing like 50 million in revenue out of what, 5 billion, or so, maybe Adobe's bigger today. But Creative Cloud is the bulk of it. It's still the majority. It's either the majority or the plurality of the revenue, and it's exactly what Canva did, and Canva snuck up on Adobe, I think, right? So, I mean, I think every company uses Canva, even if your designers are using Creative Cloud. So it's a much bigger deal. I do think the regulators got this one wrong, and maybe even they got it wrong. Who knows? Because this is why the Google HubSpot thing might be worrisome. Maybe it's how they were lobbied or manipulated, because I don't think it's competitive. Nor do I think they would have done the deal if they genuinely believed it was competitive. They wanted to expand their surface area. Scott Belsky, I mean, he's great, you've had him, right? They wanted to expand their surface area. They didn't want to take out a competitor. That would be trying to buy Canva, would be taking out a competitor. They wanted to expand what Adobe did.
Can you just help me out on the question of liquidity? Because we've just mentioned, obviously, PluralSight and what I think that could do to PE and their willingness to buy. We've mentioned their regulators and their withdrawal, or their kind of intrusion, meaning less M&A. The lack of IPOs, with Rubrik and HashiCorp being the last ones, as you said. Yeah. How do we solve the problem of liquidity? How do you explain that to LPs who ask?
Yeah, look, you got to either, again, I think it's tough. You got to decide if your glass half full or glass half empty. If you're like, listen, there's been essentially no liquidity since 2021. You had two IPOs. You can't even get liquid on Figma. The big stuff's blocked. So that's the easy way to get cash, right? It's just someone write you a check the day a big deal closes. If I can't get liquid on, $1 billion plus deals, and the multiples for the best companies are at 6x, and even worse, I think, now listen, I don't, it's hard to say because one of these IPOs hasn't happened in years, but basic folks that are close to public markets say, look, for sure you can IPO at 200 million in ARR, but there's no liquidity. If you can't distribute your stock, if you can't sell your stock, it doesn't matter much for venture.
Do you think you can IPO at 200 in ARR?
Yeah, for sure. Yeah. Maybe you'll IPO at $1 billion at market cap, and that was fine. HubSpot IPO'd at 800 million. Box IPO'd at 800 million. Shopify IPO'd at 700 million. The world will not end if you IPO, but if there's no liquidity, employees can sell their shares, and you can do a little bit of M&A, but how much M&A can you do at $1 billion? Like, use 8% of your market cap, it's 80 million. What can you buy in today's world, right? So what's the point? If your VCs can't get out and you can't buy anything, then employee liquidity is critical, but maybe that's all it really does. Yeah. We haven't had liquidity. There's random things that happen. We haven't had liquidity in venture since 2021. It's getting to be a while. And you either have to decide there's ups and downs in an illiquid asset class, and like this is part of the deal, or you should maybe panic. And this is why I tell almost every individual, do not invest in venture funds. It's dumb for individuals. If you're managing an endowment thinking about centuries, you can have a you can have a nuanced approach on liquidity, but even there they have liquidity crunches because they have capital calls and they have to reinvest money. And even folks that didn't think liquidity was important in endowments end up having liquidity crunches too, right? But as an individual, you really want to lock up your 100 grand for 16 years for a 2x return? I say don't do that.
The final one that got slammed was Mongo.
Yes.
Mongo sinking 23%. Is that the same story as Salesforce? Is there anything different there?
It is. It is literally taking a company that even when things started to get harder in 2022 into 23, still hit its numbers, still crushed it, still was a high flyer, still had the multiples, still had everything, right? People love Mongo. They run their companies on it. It's very interesting in terms of, having a long tail and being very enterprise, great CEO, like everything, competitive position, despite a lot of competitors, stronger than ever. But then saying, hey, growth has plummeted to the teens. It's not a growth stock anymore. That was just like a shock to the system. And, Dev said his discretionary spend is still being managed very, very carefully. And I'm sure that's the reason. But seeing a high flyer go to a mid-teen, I think everyone sort of thought we were bouncing off some bottom. And if you look at a lot of charts, like John and Bell's charts are great, and you can track a lot of folks. And it does look like in the aggregate, we bounced off some bottoms in first half of 2023 in the aggregate, all cloud out SaaS. But we're not seeing Mongo saying, hey, it's getting worse. Salesforce is saying it's basically getting worse. Yamini got on the last call a couple weeks ago and said, yeah, we saw a little bounce at the end of the year. And HubSpot had a great quarter, but it's not any easier. She said it's not one lick easier right now. So HubSpot not any easier, Mongo worse. Salesforce worse, Workday worse.
Can I ask a weird one? What happens to Twilio? Twilio, obviously Jeff Lawson now no longer CEO.
Crazy.
But people love the product.
Brilliant idea. Push out one of the greatest founders of our generation. Just push. Great idea.
But people love the product.
Great idea.
People still use the product.
Yeah.
It has great community. But the market cap's in the fucking floor.
Yeah.
It is not loved by Wall Street.
Well, look, I don't know the answer. Twilio is, it's the Stripe of communications, right? It has more competitors.
But if Twilio is the Stripe of communications, it is egregious that it is whatever it is, a $5 or $6 billion market cap company.
It does, but if we want to take a very short-term view, one, the margins are lower. The margins have always been low. Two, and maybe the market's overreacted. It hasn't been able to make Segment make any money, which it's paid billions of dollars for. So it's like two existential issues. It's got like a big product line that it doesn't want to divest, that's not profitable in a world where they need to have 30% margins. So in the old days, when they bought Segment and SendGrid and all these others, just breaking even was fine. But now you have to be so profitable, it's an anchor. So they've got a bunch of existential issues. And maybe Jeff just is like, if you think you're so smart and you can solve these problems. But honestly, those are I think the micro answers. What I generally try to be positive, realistic, but man, it sucks because 99.9% of us will never build a Twilio. Yeah. Twilio isn't just a good business. It's an iconic platform and brand, right? It is trusted. And I think it's good to kind of hide in Series A land with 5 years of runway. This is the place to be today. hide from all of this stuff, right? And to not have to deal with some of the market issues.
Is the best place not to be actually like your Carls selling for $2.5 billion to private equity versus your Gongs with the pressure now with your repricing being put on you? That is a hard place to be.
It's hard. It's hard. It is hard. And I can't speak to Gong in particular, but I think all of these folks, they're going to have to rebuild their entire management teams if they haven't already. It's too much for the team. Folks that I know that work at a lot of these unicorns that have done well, they've left or leaving, and it's not because they don't believe, but it's too much. It's too much change. It's too hard. You need new blood, and you need fresh blood, right?
Would you buy Notion at 10?
What do you think they're doing? 80 million in revenue?
150?
I mean, look, what like Notion is worth over 30 billion? I guess you have to believe it's bigger and better than HubSpot. I mean, it's not a perfect comp. You'd have to believe it's bigger because if HubSpot's trading at 30, right? Yeah. So you've got to believe it's going to be better than, because even 30 is only 3x. I want at least a shot at more. So is it going to be better than Datadog? I mean, I don't know what product, I guess Atlassian sort of, but Notion just does a little tiny bit of what Atlassian does. Right? Because what's Atlassian worth? We could look it up, 40 billion, 50 billion?
Yeah, 45 billion.
So you're betting that Notion's going to be bigger than Atlassian. It's newer. It's cool. It's still cooler. But those bets, I honestly don't, when I look at even across my own portfolio, I wonder at some of the growth bets being made. I don't fully, I'm happy for them. I'm supportive, but I think they...
Do you actively seek out secondaries in those rounds?
I think that there's no point in, even as a seed investor, selling before $1 billion. It's not enough money.
The impact on your fund is not
enough. It's just, it took me a little while to figure this out, but even though I'm a little slow, it's just, that's my new rule. It's just, even if it's there, and even if you could make 10x on your investment or 15x, you know what? When you start your career in venture, like, oh, 15x, that sounds, and it does sound great when you go to raise your own fund. But it doesn't, later on, it doesn't matter how any individual investment does. If it can't, you gotta find fund returners, right? Okay. You gotta find fund returners. And you almost, and I think this still creates corruptive, this is where the disalignment between founders and VCs always has been, is still an issue. Like you gotta, if the investment's struggling, you'll take $1. Hooray, I'm so excited I got $1 million back on my $2 million check if it was going to be zero. But if the investment's doing, the tough one for venture, I think, is when the investment's doing reasonably well. Reasonably well. Would you take liquidity at 500 million if you invested at 5 million? It sounds like 100x, but it's really 50x with dilution. It sounds great, but let's say you're diluted to 5%. So you're going to sell your entire position? People talk about selling a little piece.
It's difficult to sell entire positions, just like feasibly, it's difficult.
Yeah. So okay. So great. So let's say you have a $25 million position in a $100 million fund. First of all, the entire thing's only a quarter of your fund. What if you sell 10%? You get $2 million back, right? We have a co-investment. We'll leave it nameless. That just did around at 300 something million. And one of the early investors, seed investors, sold a little bit in this round, and they made 50x. They only got like 2 million. I'm like, what's the?
And that was a fund?
Yeah, a fund. Yeah. Well, let's not name any names. It's a great company, great thing they were both in. But I'm like, I get it and sometimes that's a good proof point for your LPs, but it doesn't make any difference, right? So you just gotta keep going all in, I think. Otherwise you can't make enough money. You just and they're tough decisions, right? Really, all these. If it was your own money, you might sell these shares.
100%.
If it was your own money, you put 50 grand in, and which is, a lot of money. I don't mean to, and then someone, 5 years later offers you 3 million, you should take it. No. 2 million? What's 50? 2.5 million on your 50 grand? But I mean, you should take that.
I was laughing with our CFO this morning because we've got a company where we did the first round for when it was a SaaS company, pivoted to a foundation model, and now it's worth 3 billion.
Wow.
But you can't get fucking liquidity on it, Jason. So we own 2% of it, which is $60 million in a $30 million fund. Shit, it's 2x the fund.
That is great.
It means nothing. I can't get any liquidity on it.
Yeah, it is.
What surprises me is numbers still matter to LPs. And what I mean by that is TVPI numbers still carry a lot of weight. I thought everyone knew that the TVPI numbers like that is actually relatively meaningless. And it's a shift towards DPI if you've been in the game long enough. But no, TVPI still is a big focus.
Look, there are, you would know me better than me. There's many, there actually probably more types of LPs than VCs, actually. There may be more types of LPs than VCs.
Sure there are.
But what a lot of people challenge me on this, but they're wrong. They're wrong. So many LPs are judged on TVPI, the paper markups. If you're judged as a manager at an LP on your paper markups, of course you're going to care. You can mock it and you can be Moolah and the Kula, DPI, all this stuff. It's true. But how are you judged? If you're only judged as an LP as cash distributions, then great. Hopefully in 23 years, you get a promotion. Because even if 20 VC does really well, you've got 20 managers. And so altogether, it's going to take you 20 years to make enough money on this to prove yourself. You got to do the, and should it be discounted? Or do we account for TV? I don't think we account for it properly. That's my criticism of TVPI. But you got to use a KPI. You have to use a KPI.
What do you mean we don't account for it properly?
I think markups are corrupt behavior. But you need something, right? You need something, but they do corrupt behavior. Are they marked to, should we have mark to market? Not to get down the venture road versus This Week in SaaS. Should we force people like, crossover funds do to have to revalue their investments every quarter? Maybe just a little bit. Maybe that would be better.
Are you very reflective of your book? Like, do you mark down your book very proactively?
At the end of 12/31, I took a big red marker and I went overboard. I cut everything that needed to be cut. In fact, I just had an extremely minor liquidity event, and it's 3 times what I marked it down to in December. It ain't much, but it is 3 times I marked the investment down.
How did LPs respond to the red pen to the portfolio?
They didn't care. I didn't get any feedback. I mean, the fund's still fine. But I didn't get any feedback. Maybe I didn't ask, right? My sense is that was unusual last year. My sense is people were still holding on to valuations. But I'm like, listen, I'm going to cut everything back to the bone so that, so there's only upside. I don't want anything to only go up. There's only upside.
I think people are still holding on. Structured rounds, inside rounds, they're continuing to keep prices high.
Yeah, so that's why TVPI is corrupting for this, because you wouldn't, if you didn't value companies like this, no one would do endless extensions on unicorn rounds to prop up valuation. That's bad. Should you have no markups at all? I actually think that's not the dumbest idea, but it's too exhausting for LPs.
What happens to companies like Retool, who was super hot and then kind of just continued but lose the heat over time, and what happens there?
On This Week in SaaS, one of the more discouraging, so the multiples are discouraging. The lack of only 2 IPOs since 2021 is discouraging. And we're going to get to the positives. Again, Canva's growing 40% at 2.3 billion and monstrously profitable, and it'll be there's going to be some great IPOs coming, which we could talk about. One of the most discouraging things I saw was Tomas Tungus did something a couple weeks ago. I put it up on SaaStr. You can search for him. And that the number of 50 million plus software exits in the US that can be tracked, and some aren't tracked for a variety of reasons, it's averaged about 57 or so for a decade, and it's stuck at 57. So the problem is we have so many retools now, so many great, it's the number of, so that's a decade. I sold a decade ago. Okay, and it seemed rare. If you think about it for a minute, if the number of 50 million plus exits is constant for a decade, and all startups have exploded, 20x, 30x? Yeah. It has to mean it's harder to get acquired. Forget about Hartscott, Rodino, and Figma. It has to be harder if it's still only 57 deals. And how many deals are VCs doing like M&A? And so this, I think, quietly was the most discouraging thing I saw, which is getting acquired is hard as F. It's hard as F. And we all think like, hey, let's just get the company to 5 million or 10 million and someone will buy it and HubSpot will buy it, or it's 57? 57? I think it needs to be 570 for venture math to pencil out. It's worrisome. When do SaaS companies, micro brands, get to a stage where you start to see reduction in CACs because of micro brands? You've said before, like when you get to 10 million in ARR, I think it was 10 million in ARR, you get a micro brand maybe in a vertical. Maybe early, maybe a couple million.
Maybe a couple million. Yes. When do you start? I really think to this quote of yours often when I'm investing, because I'm looking at CACs going, when does the micro brand CAC reduction happen?
But I actually find it happens by a couple million in revenue. You often will get half of your deals from not just inbound deals, but folks that heard about you. Folks that in your little niche, in your little niche, that have not in the grand scheme of things, no one's heard of you, but other folks just like your customers. They start talking about you. They go to events. They meet up. They have their own little communities. They talk about you. So you start approaching 50% of your leads are free, free in quotes, but they are free, and they're inbound and they're great. And so if you did nothing else, your CAC would go to zero. And frankly, that's what I accidentally did as a founder. That's why I went profitable at 5 million in revenue. Is I went to a zero cost marketing model. But the problem with that is right when that happens is when we start to raise money and invest in sales and marketing. So we kind of lose it works, like that propels us up the curve to scale, but we don't really get a net CAC benefit because we layer in more paid along with the free. So you never see, well, a sad thing we learned, one good thing we learned in SaaS is until the Salesforce decline, we learned that generally high NRR lasts forever. It lasts to $1 billion, $2 billion, $10 billion, but we also learned that CAC never comes down. And actually the public SaaS companies have the highest CACs of all.
So we said about positivity.
Yes.
Because we want to be more positive in this week in SaaS, otherwise we'll just have people jumping off the bridge. When we think about like the IPOs that come, who are the next contenders? Who do we think is going out next?
Obviously, look, we hit some of these. I mean, Canva, Figma, these will be great IPOs.
Do you think Figma will go out anytime soon though?
I think that Stripe will be a great IPO. Forget about the valuation. These will be great IPOs. Stripe will be a great public company. Canva will be a great public company. Plaid will probably be a great public company. Like a lot of these names that we know, they're not going to IPO at 100 million or 200 million IPO. Canva's going to IPO at 3 billion in revenue.
What is that IPO at?
Canva? I don't know. I mean, listen, it's hard to see.
They had secondary at 26 billion earlier this year.
So let's say that, I mean, what's the highest possible multiple in the market would be 15, right? So that could be 45 billion. So that sort of ties to the secondary hoping to double their money in an IPO, right? There's just would be no precedent in today's world for it to be higher than 15. Yeah. And again, it sucks that Klaviyo is at 6x because I don't know that, I mean, Canva is bigger. I don't know that it's better than Klaviyo. So 6x or 8x would be like a bummer, right? Then you'd have like a 15 to 20 million dollar market cap. But from the founders and the early investors, it is what it is, right? It is what it is. But it could be flat, right? It could be, and frankly, for a growth investor, if the secondary was at 20, there was a round at 40, right?
There was a round at 40, and then the secondary reportedly earlier this year was 26.
But maybe that's okay, Harry, because maybe if you invest in a great name and you only end up making 1x on some of them, maybe it's not the end of the world. Maybe that's part of the bet, right? Maybe that's part of the bet. I don't know what they're thinking. You hope to get 3x on a lot. You hope one per fund in this growth stage is like a 10xer, and if some of them are 1x, and you're pretty confident, maybe it's not the end of the world.
So Canva agreed. I'll take a bet with you. I think Stripe will still be private in 4 years' time.
Well, look, I
don't think the Collisons ever want to go public with it.
If you and I were running a startup together at their size, and we personally didn't need to create a lot of liquidity for ourselves, and we could literally create structured secondary every 6 months, why wouldn't you stay in the world of being a builder? Because you look at Salesforce. The problem with public companies here, here's the problem for the week in SaaS, and again, I do want to be positive. Here's the real problem. I think we've made a terrible pact with the devil in public SaaS companies, a terrible pact, which is the market's told everyone they had to get efficient, but there's no money for R&D. There's no money for R&D. How can you, if Salesforce is going to get to 40%, it's coming up on 40% margins, where's the money for engineers? Where's the money for sales? Sales headcount is down, right? Engineering headcount is I don't know if it's down. Sales, like where is the money? And so I would stay private as long as I could, so I keep investing in the product. And then when I finally had to, fine, I've got to be profitable. But no one cares if you're profitable 6 years before your IPO. They care if you're there when you IPO. Palantir ran that playbook. Their metrics were atrocious before the IPO. They weren't even SaaS. They had like 20% gross margins. Forget about profits. Then magically their margins were in the 70 the year before the IPO, and they've done pretty well.
Is there anything else positive that we should discuss in this week in SaaS?
Again, we started off with some tough news, and look, it was a terrible week, but there's more good news out there than bad. Multiples are down. That's not fun. But again, let me pull up our list. Canva, 40% at 2.3 billion in revenue. Toast, 32% growth at 1.3 billion. Samsara, 39% at 1.1 billion. Monday, now this is a super interesting one. You know who Monday doesn't really sell to? Tech. They sell to non-tech. Salesforce, single-digit growth. Monday, 34% at 900 million in revenue. 34%.
But let's just go through those. Canva sells to end consumer.
Yeah.
Toast sells to end consumer being restaurant owners.
Yeah.
Monday sells to SMBs, small creators.
Yeah. Samsara is selling to the end economy, not consumers businesses, but the end economy, right? Zscaler, 32% at 2.2 billion. right? Security remains on fire. And then Klaviyo, we talked about 42% at 800 million. So it's like we can look at all the Mongos and the Workdays and the Salesforce they look done, but I found six leaders that are all growing at now they're not 2021 not so rates. So you basically have a couple choices. You can hibernate, you can blame, you can say woe is me, or you can say, listen, maybe I'm not selling to restaurants or to end designers, but what can I find in here? Where are the gems? And I remember Henry Schuck from ZoomInfo like a year and a half ago said this thing. It was early, but he was obviously seeing everything early. It's like, I think a year and a half ago, he said the good news is our non-tech customers are growing 20-something%. The bad news is our tech customers are growing like 6%. Now it's worse. Now I think they're negative, right? Because their NRR has fallen to like 85%. It's ZoomInfo.
Would you be a buyer or a short on ZoomInfo?
Generally speaking, when you have great founders that are committed, I'm a buyer, so I would buy. There's negative things, but like Henry's a great founder who's done this from scratch, basically bootstrapped all the way here, totally committed to the space, will never quit. Now there's Apollo, there's others, but you're gonna ultimately outlast the ones that quit.
Can I ask actually we mentioned kind of the kind of hyper growth companies that are now non-growth stocks,
yes.
Be it your Boxes, be it your Dropboxes, be it your Salesforces. Which one that has transitioned from growth to stable 4 to 6% grower do you think will reflate in the next few years? And what do you think will be the next one that is a hyper grower will go into a slow growth stock?
I think the ZoomInfos and the Bills that have gone through a patch with incredible founders that have a multi-decade commitment will crush it. I don't know how some of the Zooms will do it, right? I don't know. I mean, Eric's as good as it gets, right? They got the worst. They got dealt the worst COVID card. It seemed that they had the best, $1 to $4 billion in 1 year, but they got dealt a tough hand, right? That's a tough one. So I don't know. I don't know. I'm gonna say that folks that are going through a patch like a ZoomInfo or Bill, they're gonna pull out. Folks that maybe like Dropbox have decided to lean into this world. It can happen, but you need, it's funny, when I was at Adobe, going back in time, Adobe wasn't really growing. Its market cap was nothing, right? And then all of a sudden cloud took off. It's funny, most folks didn't think it was really gonna work. SaaS really exploded. That helped. There will be others like NVIDIA that did not predict this, right? So I think if you stay in the game, something could happen for these leaders that have dominant brands, but I don't know on their own. It's just, I think that the tough thing is we've learned you've got to sequence these next acts like HubSpot did. And if you don't, it's so hard to do it later. It's not impossible, but it is so hard.
Okay, so I want to do a tweet of the week, and I love this. You said one large accidental mistake founders can make in fundraising is to ask for too much money.
Yes.
What did you mean by this, and how does that impact the advice that you would give to founders listening?
Let me step back for a minute. Too many founders are still giving you terrible advice from 2021 into 2022. They still give like run a process, give people 1 hour to decide. I literally got an email while I was here, Harry. The email was pretty good, okay, from this founder. I think they're at 100K ARR, okay, and they're doubling. Okay, so they're growing, but like this is not a rocket ship yesterday. And and in bold, it's like the deal's moving really fast. Like, I don't know who told you to write this or where you found this on the internet, but no, this is not the right way to approach it. Is listen, we have something that's early. Let me tell you why it's going to be great, right? So much of the advice is bad, and people are still asking for too much money. They're asking for too much money, and I was pulling this up for SaaStr Europe, but Gong's Series A was 7 million. Series A was 7 million. That wasn't that long ago. That was 2017. Yeah. That used to be a Series A. Now it's a seed round, okay? And so you see these numbers in the media and you hear about them, but be very careful that that's appropriate for you, because you can just rule yourself out from investors. It's just such an unforced error. It's hard. Founders, there's things.
So for founders listening, what do you mean you can rule yourself out for investors?
You have to, if the fund size isn't big enough to meet your ask, many good investors will quietly opt out because there's too many deals. Okay, the biggest check I can write, you can tell me what yours is next. The biggest check I can write is $4 million. Okay, I've written quite a few $4 million checks. I could write a little more, but when I write a $4 million check, Harry, it has to work.
Well, yours is 7-8% of your fund.
Yeah, it's a lot,
Yeah,
right? So it has to work. I can't, otherwise, it's like PluralSight. Like I'm dead if that thing. Like I can survive it, of course, but it really sucks when I write a $4 million check. So when you ask for 10, not only do I not have money, but maybe I can get Harry to do the deal with me, right? But I have to believe it will absolutely crush it to do a 10, because then I got to bring Harry in to do 4, and then we'll find our friends to do 2. So we can do it. But if you're just getting going, you know what I'm going to, because how many, I mean, you know, you get, what do we get? 40 or 50 of these emails a week. It's just easier to not respond or to be kind, right? Now, if that same company with similar metrics says I want to raise like 4 to 5 million, or even they do something dumb like 2 to 5, it's okay even if it doesn't make sense, then I'll take the meeting if the rest looks good. But I'm not, if they're asking for 10 or 20 or crazy things, it's just not. Once in a while I'll do the meeting when it's so amazing, right? When it literally leaps, but you have to check every single box. It's easier to just say, listen, this founder doesn't get it. Like I'm just the wrong match for that, right?
This is unpopular. I don't like big ranges. 2 to 5. What you do with 2 is completely different to what you do with 5.
I said it intentionally. Like that wasn't a great answer, but I'll still engage. I'll just say, listen, if it's a third-time founder and they're asking for 2 to 5, I'm skeptical. Yeah. If it's the first time they've raised any capital and they don't know, you got to cut people a little bit of slack, right?
You do.
Yeah. So, you know, 4 to 5 is better. 4 to 6 is a good answer, right?
How many founder meetings do you take a week?
True meet, like true Zooms.
Yeah.
Try to do 2.
2 a week.
Yeah. I try to interact for real with every single good email, like for real. That's good. But I try to do as much as I can.
How many good emails do you get a week? Trudy.
You know, it should be more than ever because there's more good startups than ever. But what is super great or good?
Like where you're like, really, this is good.
You get. I would say you get 2 good ones, really good ones a week, and if you're lucky, if you get an insane one a month. You're lucky if you get an insane one.
Was Talkdesk an insane one?
Yeah, that was that. I mean, there were some quirks in it, but that one was an instant investment.
Was there ever a good deal that you did that had a email?
No, but that might be my flaw. Because I just
missed quite a few. Yeah. Because you've had like the best of the best in SaaS email.
Yeah, when the emails are bad.
Well, it's like I remember there's the founder that I did the deal in, and after the round that you saw. Yeah. And I sent it to you because you were like his hero. Yeah. And you're like, oh, he emailed me years ago.
Yeah, it's bad, but it's like, to me, it's like recruiting. Like you can if someone writes you a terrible email for a position to be director of content at 20 VC, like, hi Harry S. I recently stumbled upon VC 20, and like you can mock that, but once in a while maybe there's a gem in there. But I find those recruiting meetings are so exhausting. Actually, last year I've taken some of them, and I really want to blow my brains out. And the problem with those founders is when you do those meetings, when you do the terrible Monday emails like they joked about when I did it, and others, you should do them, but like, how are you gonna do 50? Like you need an army of analysts, and you need to do it. And so, because if the email's terrible, but you will miss things, right? You will miss things, and you'll also miss things where some founders that literally you could invest in but don't need money, sometimes they write the wrong emails too.
This is true. Right?
And those are the ones you'll miss too. So it's a but just because then you got to do an hour, and then they got like 8 follow-ups, and then you just got to keep following up. And
am I allowed to ask some really unfair questions now?
Sure.
In person, you can tell anything. How much does SaaStr do in revenue?
SaaStr?
Yeah.
Well, this will be our first crappy year, but like 25 million.
Why is it a crappy year?
Because this is the first year where we've just had so many unicorn SaaStrs that imploded. So we probably lost 60 sponsors, 70, 80.
Wow.
Yeah. Now, it's not that they're bankrupt, but lost them.
Got you. And so that's a flat year for revenue? Or
no, it'll be down.
Down year?
Yeah.
Do you think that is also because events are less exciting than they were? Like events in SaaS used to be the thing. Now content is the thing.
It's mixed because on the one hand, field, every report I've read recently, field is still 40% of all marketing spend, field marketing. Okay, so the budgets are still there, but some people don't even want to deploy them. Okay, so that's one issue, right? And then there's a whole issue where we thought that when we came out of lockdown that people would want to be together more, right? And I think what I've learned from the events thing is it cuts 2 ways. On the one hand, it is great. Even we're here in your office, your team is here, but almost everyone's at least running some kind of hybrid team. Okay, no, almost everybody. And so we've had to learn about this, but a lot of people just don't want to get out of the house.
Yeah.
They don't want to get out of the house. And so events, on the one hand, they're very exciting for folks, but I think a lot of folks just literally don't want to leave the home. I mean, we got in, it's funny, I'll tell you a little, it's tiny, but this is a niche topic. Amelia, who runs a lot of SaaStr, was saying she'd gotten the most cancellations this year ever for a very specific reason. People wanted refunds. Anyone complains, we give them a refund. Like we have a tiny team. We're not going to argue. You give your refund. People actually, they wanted to buy a ticket, but they just, not only did they want the list, which they don't do, they didn't want to come. They wanted the benefits, but they didn't want to come. So all this stuff cuts both ways. And I think that we all kind of thought the world would pendulum back in certain ways. I'll say I don't know the answer. I don't know the answer, but
because I as like your friend, and this is me being really unfair turning this into a show as well.
Yeah.
But I'm like, I get the event strategy helps the investing strategy 10 years ago, but I look
it
at
never helped.
I disagree with you there. No, when you look at the founders,
having a community helped. There was no need to do an event.
Then why do it? It is the hardest form. Like content is so much
very
easier.
hard.
You can write a Reddit in your own home with a coffee, and we can chat on a podcast from our own homes. Why do all this shit? I mean, I was walking around the city with Mum today, and I said to her, God, I got a way better deal than Jason. This events business is hard.
Well, I'll tell you a funny VC-related story in a second. First of all, it was an accident, right? It was meetups became thousands of people getting together. SaaS was smaller when we first met, but there wasn't a lot of folks sharing how to do it. So it became a movement, right, in the early days. So it became its own thing. Two reasons. One, it does make a difference in a lot of people's lives. And you only have so many orbits around the planet. And if you can, even if it's not, maybe it's hard or the time ROI is tough, if you really can do something that other people can't do. Very few people can do an event for 15,000 people in the U.S. area.
Totally.
And the classic Sam Altman, who was here, saying, his classic thing is say, do the things that are easy for you, that are hard for other people. This is something that's hard for us, but much harder for other people. Like much. I mean, what we can do with
everyone says to me, do events. I'm like, no way.
Yeah, you would need and you would lose millions, and you would need a huge team. So, but it's a question, and so one is we're good at it. Two, it's impactful, and then the third one, this I learned from Aaron Levy. I asked him, when I don't do very many podcasts, but I do a few, right? And when the last few ones I've asked people, why do you still do it? It's my opener. I asked Jennifer Tejada, I asked Aaron Levy. And one of the things he said a bunch of things about AI in the future and other things, but he's like, it's a jigsaw puzzle. So Box is doing $1 billion-ish a year, a little bit more, right? So 20 million goes to 200 million goes to COGS, to servers and support. And he's got 800 million to play with each year. And for him, he's like, this is what's interesting to me. I mean, the technology is interesting, but what I mean is it's engaging. So putting together a jigsaw puzzle, you have a jigsaw puzzle at 20 VC, you're putting this together all the time. So we don't always choose our jigsaw puzzles, and maybe in a certain world we would choose the easiest jigsaw puzzle, that's the simplest one, but I think sometimes our jigsaw puzzles pick us. And what I do know is that, I've never been depressed, but the closest I've been is the 2 times I sold my companies. So I would be reluctant to give up a jigsaw puzzle that we're good at, right?
What happens to SaaStr in 2025? You're saying at 25 million in revenue, decline from last year. What was last year's? 30?
Yeah, almost 30.
Almost 30. So say, whatever that 4 million reduction. What happens in 2025? Does that reflate?
If you'd asked me in 2021, I would have, not for myself, but for other people, I would have given you some bullish number for the troops. Not that I'm pretty neutral. I would tell you, here's the exact path to 100 million. And I don't know the answers today. I don't know all the answers.
What's the margin on an events business like SaaStr?
Basically, when you look at things that are vaguely similar, like a Shop Talk or Money 2020, and again, these don't have communities, but or Con Lions or other things, and a lot of these are public, so you can parse them. Basically, you need to get above 20 to make money, and then, or Coachella. But once you're above 20, it becomes, I'm way oversimplifying. Then you start to get very high margins, but it's very high. So when you look at the public companies in the space, they do have like 30 to 40% operating margins, but you have to get above a $20 million nut to do it as a business, right? Not that we started as a business, but you do have to stay above that, right? So you do 30 or 40, then it could be very lucrative if that's what you want to. If you want to take cash out of the business, you could make a lot of money.
The question everyone asks me is like, financially speaking, are you a media company or are you a fund? And I always push back incredibly fast and say I'm a fund.
Right.
We leverage media to find great entrepreneurs and win the right to invest in them. Is that the same answer for you?
Who knows? It was the right decision. I think of SaaStr as a community first, and I spend. It used to be 100%, but I still spend most of my time one way or the other thinking about community. Where can you add value? And then I think out of this community came investing very early. And then out of this community accidentally came a media events business. It wasn't even a business until a couple of years ago, for real. And they come out of having a community. And I do think that that's powerful, but it's a little bit different than media, right? And also, if the only goal is to invest, then you don't want to put one more ounce of energy into marketing than you need to do to close the next Figma. You don't want to do one more 20 VC podcast. You don't want to do one more thing because there's not an infinite supply of Figmas, right?
Totally.
So if you view all of this as marketing for a fund, that's great, right? And certainly folks are much more aware of marketing for funds than they used to be. But you don't want to, you could argue that for me, I way crossed the line. It's way too much time and energy just to try to make a couple of investments.
How much time do you spend on the events business versus or community building versus investing?
It's not that it
used to be. Do LPs not ask you?
Yeah. Well, it's interesting. I mean, this is a lot of detail. It used to be before 2020, it was actually more time because the team was terrible. Oh my God. Every week, terrible things would just happen. Like we almost died. And we had one head of events who forgot to reserve the venue, the convention center. She forgot to reserve it. Do you know how stressful that is? Oh. We can always redo the pod.
How did you find out?
Well, like a lot of mediocre people, she hid it until the very end.
Oh.
Until 3 months before.
And then she said, I'm sorry.
She never told anybody. So every year I had multiple issues like that, Harry. It literally almost killed me, right? So actually it used to take more time than it takes now.
What was the biggest near-death experience for you with it?
What's that?
What was the biggest near-death experience that you remember?
From all of this?
Yeah.
Well, it's just these terrible event producers. I mean, we did lose $10 million in March 2020. We were the first major event shut down by COVID. RSA got done, and then San Jose shut us down when there was one case off the coast. So we did lose $10 million. That was not the most stressful, but it was pretty stressful. The woman forgetting to book the convention center was pretty bad. There's a few like that. Because when you're in tech, it's if you're relentless, you don't have to work with mediocre people. But in the events industry, almost everyone's terrible. Literally terrible. And they have these agencies. So let's say you want to do a small event's very easy. You just rent. We'll go to the Nobu across the street. Okay, we'll rent the ballroom. We could probably do it for 20 grand. Then when it's bigger, 200 grand, 500 grand. And it's turnkey. They have a projector, right? It's pretty easy for a one-day event. When you get bigger and do these multi-day things, they have these agencies out there, these wonderful agencies. Basically what they do is you pay them as much money as they can get out of you. And they hire 100 temps who know nothing and just ruin everything and do a terrible job. So that doesn't work. That's why Web Summit has to hire like 200 folks out of college because they can't get that stuff to work. So it's an interesting life experience. I've never worked with so many just truly terrible people that didn't care, random people making, in many cases, terrible compensation, like not tech level compensation, terrible compensation. And so it's taken us a lot of years. Now we have a great ops team, a great content team. We still have a few things, but 80% of the team's really good now. And so the amount of time that I have to spend on operation, like this stuff, like the woman that forgot to, never. Like I don't have any.
Have you become a better CEO over time?
Oh, much worse.
Why are you worse? And then we'll do a quick fire.
Because I care much more. I care like 20 times more about my team than I used to. But I can't bullshit anymore. I can't tell people it's great job. Great. I know we showed up on a Saturday, no one was here, but great job, team. I can't, I'm too transparent, right? I'm no bullshit. And you have to, so I'm not as good. I used to be a pretty good team rallier, right? Now I'm like, you want to work with me? Great. If you don't, The door's right there, and I'll pay you 60 days. But like, I know I'm not going to convince you to work with me anymore. So there's a set of that kind of tools that I just don't have the patience for, right?
I totally get you. Team rallier is an important skill.
So important. So important. I remember when things were hard at EchoSign, I had this huge thing on the wall, and it was our journey from 1 to 10 million ARR. And I had this little animated guy, and I would just move it every week at our team meeting, 1.6, 2.1. And it was pretty funny. We'd move it up, and I'd rally, we're at 3.182 million ARR, and I'd cheer him. And you just rally. It was such a great vehicle because it felt like it took fucking forever to go from 1 to 10 million in ARR. But today, no way. I could not do that. So I think about it a lot, and I think I wish I was. But the odd thing about it, Harry, is just the reason I actually struggle with this all the time, because I care so much more about people now than I used to. Like in the old days, like we had such a great sales team, Sam Blond, Sierra at Brex, Jameson, who just left as SVP sales at Gong, so many folks. Like most of those folks, I never even talked to them. But I kept moving the thing and bringing lunch in. That's what I did. Now I care so much more about every single person. And I think it might be a negative.
Right, we're going to do a quick fire, my friend. Otherwise, we could talk all day.
Sorry, you brought it up.
No, I love this. Yeah. What's the best first founder meeting you've ever had?
I will say, it is interesting. I will say, and I wish I was an investor, I will say the best founder meeting I probably had was with Parker Conrad in the beginning of Zenefits. I introduced him to Sam Ballon, and that's how I got going.
Why didn't you invest?
I told him I would, and then he went and took the money from Andreessen.
Would you have done it with him at 35?
Yeah, I told him I would do whatever he wanted, but he took Andreessen. That's okay. But I'll tell you why. It's interesting. I don't know. I mean, obviously Rippling's very successful, and I've met many great founders since then. But that was the best. Maybe that's not fair to best, but best in the first group, because that was the first founder I met. And it was very early on. I had barely started investing, where you could just see the future through the founder. And those are the meetings. Then you should never do anyone where you can't see the future through the founders.
You're the founder of a SaaS company today. Yeah. You can choose any board member. Who would you choose?
I think I'd pick Toby from Shopify, because I think he'd friggin' kick my ass. We have too many founder-friendly Yahoo, great job Harrys on boards. I'm just so sick of it. Toby just seems like he just doesn't suffer fools. And maybe you don't want to work, maybe not everyone would want to work for that. I would work for him. I mean, I've never met him, right? But that's who you want on your board.
What are the first signs that a founder's quiet quitting?
Too many excuses for mediocre VPs. Harry, my VP of sales, I mean, I know we only closed 8% the last couple quarters, but Jim's doing a fine job. When a founder has acquiesced, it is hard to rebuild a management team, right? Especially when growth are slow. But when you've decided that's fine, when you've acquiesced to having a mediocre management team, it's over. How are you ever going to regrow if you're with a mediocre management team? So when you start covering for a mediocre management team, I'm not saying fire them. That's a more nuanced topic. But if behind the closed doors of a board meeting, you're covering for mediocre VPs, I give up on the founder. Like I almost instantly give up on the founders.
Okay. Final one. Yes. We need to have another bet.
Okay.
What do you fancy as the bet?
Boy, I really blew the IPO one. I really thought I was right.
That one was a whiffer.
But I believed in it. I really thought there were so many folks at 200 million.
I know, because you took a 3x leverage on it.
Yeah, I really thought I was going to win. I really thought I was going to win that one.
But listen, you met my mother this morning, so thank you for paying for her Christmas present.
You're welcome. I'm good for it. What's the next bet? This is a tough week in SaaS to make the bullish bet.
It is.
But it's a one-off bet, or it's one you want to reuse in the future with other people?
Either one, my friend. You can choose. This is the first this week in SaaS. I have to be hospitable.
I think the bet. I think the best bet is, because we're all making it, is what will multiples be at the end of next year?
Ooh.
Because that's our future.
Yeah.
If we're going to a fourth year of crummy multiples, well then we'll adapt. But that would be a bummer, right?
Okay. You can take the bet there.
Yeah. So. But I got to quantify it perfectly. So I think what we need is to be in an 8x world. We need the median or average, very different, but we need the median or average SaaS public company to be at 8x. Obviously, some can drag it down, but the good ones will drag it up, right? So we're in a 6x world today, 5.8, 6, whatever version you use. I think we need to be an 8x world for all this to be worth it. So
do you think we will be? Let's do that as the bet. Average 8x, end of 25.
I think I'm going to only bet you 20 grand on this one because I'm not sure. I was confident of the IPOs. I was confident it would be an IPO week in the second half of this year. This is my worst bet ever. I'm just going to lose left and right. There are reasons to believe that. The worst one. This one, I just need. I want to believe. I need it to be true.
And so you're going to take the over on that?
Yeah, I'll do 20 grand. That at 12/31, at the end of 2025, we're back to an 8x world.
Great. I'll take the under on that. Well done.
Okay, good job.
Jason, thank you so much for doing.
Okay.
This has been so much fun. And what a joy to do it in person.
Yeah, it's great. It's great. It's great to be at the worldwide headquarters for 20VC. It's about, what is it, about 100,000 square feet that we're at here?
Yeah, something about that.
Yeah, the 50 analysts above look tired. You make them all work on Saturday. We're here on Saturday. I don't know whether you're watching or listening, but there is an army. It looks like we're at 0.72 or some hedge fund up above. There's literally, and there's no, right down here it's nice, but up above there's no AC. And so there's like 100 analysts scouring Crunchbase for deals.
We don't
scouring
feed
them for deals.
Yeah.
You don't feed them. It's eat what you kill, right? There's no salary. It's just it's deal by deal, 0.5% carry if you find a good deal, and that's the way.
So
there's
you've
100
gotten
up there,
nicer and I've gotten more nasty. Yeah. Dude, you're a star. Thank you so
thank
much
you,
for
Harry.
doing this.